Okay, and so we're recording. So, hi everybody, thanks for joining us. My name is Pat Larsen. I'm the CEO and co-founder of ZenLedger. We help cryptocurrency investors and accountants bring all their transactions together and produce tax reports and financial reports for you so you can trade better, optimize your tax assets and liabilities, and just stay compliant. And joining me today is Taylor Pearson. He is a man about town, an author, an investor heavy into crypto. Taylor, would you like to talk a little bit about yourself?
Yeah, sure. Thanks for having me on, Pat. Looking forward to this. So my background, sort of professionally is in sort of the digital marketing realm, but then sort of as it relates to crypto, I kind of came in through this sort of like anti-fragility, complex systems angle. I read a bunch of Taleb's books, and I was really interested in this idea of like, how do you build sort of robust, complex systems? And so when I started learning about Bitcoin, it was like interesting. This was maybe like 2013, 2014. At that ranked like $1,000 in 2013. I was like, oh, what is this? This is interesting. So I started reading about it and learning more. And so that sort of like was initially the nature of my interest, and then sort of gotten more interested in the monetary side of things and the whole Bitcoin and global sovereign money, and what does that mean, and what are the implications of that?
Have you gone full Austrian economics?
I have read the books. People told me to read the books. I read the books. I'm 2/3 Austrian, maybe. I think there's some interesting points, and it's generally underrated. But there's like a few things that there's like a real. I don't know. Sometimes there's like a real insistence that the only cause of bubbles is like government interest rate policy. Yeah. Which seems, it's like, yeah, I think, yeah, anyway, the idea that that's a significant factor or a meaningful factor, I find like compelling and interesting, but then there's like, that's the only factor is very strange.
As a former military guy, I always can't get past the state monopoly on violence. Like the reason you have a state is for like group protection against other people, right? That's why you have a village. That's why you build a wall around a village. That's why you build a nation state or city state, and then you keep going, right? And you just make your tribe bigger so that it's more survivable. And it's like, like America at least has like a lot of natural resources, a lot of military resources, and those things have real value, right?
Yeah, I guess the part that like resonates with me and makes sense is just like, at least when it comes to like the monetary policy side of things, like when you centralize control of monetary policy in like a relatively small group, like those people tend to do things that favor themselves.
Sure.
And like that's just how, right? That's what humans do. And so like, the reason like democracy tends to be better than dictatorships is like, no one individual has as much power to go unilaterally fuck everything up. So which people complain about like the dysfunction of like, so it doesn't get anything done, but it's like, they also like the guys you don't like in there also don't get anything done. Which like means, which is significant in some ways. It's like the Constitution and Bill of Rights were good, and like it's been really hard to fuck it up.
Yeah. Have you read The Dictator's Handbook?
Yeah, I have. I'm working on a book on sort of like Bitcoin and crypto, and I reference his sort of idea of the selectorate, which is, right, if you've read it, this idea that sort of the distribution of power within a system like affects the overall sort of outcomes. Like if you have a dictatorship, you have potentially very high levels of efficiency, but also potentially sort of like catastrophic risk. So like on the good side, maybe you get like Lee Kuan Yew, or was the Korean guy Chung-Hee Park, who were like basically dictators for 25 years, but they were like basically benevolent dictators and like mostly seems to have been helpful. But then on the other side, you get like Mobutu Sese Seko and Stalin and Mao and those sorts of people, which tends to be very, very bad. So like net probably end up worse than.
Yeah, I think so. The core is like a dictator can have a very small group of people that they have to keep happy so the dictator can remain in power, whereas a democracy forces you to keep more people happy. So it's less likely that you're going to get, you're more likely to get populism, obviously, but you're less likely to have like a terrible famine where all the peasants starve to death, but all the rich people like survive, right?
Correct. Yeah, I guess the way I think about it is just like it's a distribution of power, right? There's like X amount of power to get things done, and like by spreading that out with more people, you're able to like keep any one person or small group from like unilaterally making decisions that favor themselves at the cost of everyone else. But yes, on the flip side, you can get sort of demagoguery.
And so you see that with like Bitcoin versus like EOS or Ethereum right now, right?
Yeah, I guess that's the part of like the Bitcoin thesis that I find compelling. Like, if you think about, I thought like, what is the sort of the dictator's handbook notion is the idea of like the selectorate, like what are the amount of people that have power, and he has like different tiers, right? So like, the commentator on Fox News probably has more power over than like a regular voter, and you can sort of like tier them out. But like, what is sort of like the selectorate of Bitcoin? What are the tiers? But, like the core developers, the miners, people running full nodes. I think like the whole user activated soft fork and SegWit 2x was like a really interesting test of like how that power was like actually distributed. And, based on that, it seems like the full nodes actually do have quite a bit of power in terms of like where the system is going, which I think is like a really interesting dynamic. And so, yeah, if you think about sort of like crypto through that like selectorate lens, like Bitcoin is very interesting in that it almost certainly has like the largest selectorate, and the fact that it's very focused on keeping the chain size manageable enough that like individuals can run it on like consumer hardware. Probably means it will continue to have the largest selectorate for.
Yeah, it's quite robust, right?
Yeah.
Oh, cool. So in terms of how you think of that as an investment thesis into crypto, like how does that kind of inform how you're thinking about the next like investment horizon?
Yeah, so I guess sort of my big thesis on crypto, of which I sort of like see the selector as a part, is this notion of transaction costs. So there's an economist from the 30s named Ronald Coase who wrote this famous paper called The Nature of the Firm, and the premise is basically like, if markets are so great and they like handle all these transactions so efficiently, like why do we have these kind of like planned socialist islands in the middle of the sea of markets that are called firms, where like, if you hire someone for a full-time thing, you don't like renegotiate with them every day, like, how productive were they that day, and, increase or decrease their pay. It's just like, you sign a long-term contract. So things with firms. And so his answer was basically transaction costs, right? So when you go out into the market and you want to buy a good or service, you incur like various transaction costs not related to the like the cost of producing the good itself. So like you're going to buy a car, there's like search and measurement costs. You have to like find all the different car options. You have to measure the quality, how good are the tires and the axle and the air conditioning and like whatever the things you care about are. There's like a negotiation cost, right? Like we've got to, if you had to renegotiate your employment contract every day, like takes up a lot of time, like maybe doesn't make sense. And then there's like enforcement costs. So like, you have to have some sort of like recourse to be able to enforce that like the contract is honored by both parties. So if you sort of think about those things, like those sort of transaction cost factors sort of delineate the line between firms and markets. And so sort of the most recent wave with the internet was like a reduction in sort of like search and measurement transaction costs. And I think we think about like there's now an industry called search, right? Like if you want to go, like if you're making an airline reservation in like the 80s versus making like an airline reservation now, right? Like you used to have to like call the airline, and you would like call United, and you would call American, and you would call Delta, and what are your prices, and da-da-da. Like now you go to like Google Flights or Travelocity or whatever, and you just like, I want to leave Seattle between 12 p.m. and 5 p.m. and I want to arrive to New York between 7 a.m. and 10 a.m. and I want to pay less than $700, and like whatever. You can the search and measurement there is much cheaper. And so, this is how I think we got sort of all these platforms, all these aggregators. Effectively, they're just creating marketplaces where they're standardizing these sorts of transaction costs, right? Like you go to Amazon and, I buy a ton of crap on Amazon, and most of it's from third-party sellers who I've never met. I don't know what country they're in. I have no idea about anything how it works, but I know I'm buying it from Amazon, and like they're enforcing certain terms of service. And so like, if I get the thing and it sucks, I can return it. And so I'm not as worried about it. But what the internet didn't really do was sort of affect the transaction cost of trust, right? Like to be able to enforce those contracts, like ex post is the economics term, right? So what the way I sort of like think about Bitcoin and crypto is like if the internet sort of reduced that search and measurement cost, and maybe that sort of negotiation cost, we're able to do that electronically. Like Bitcoin and like crypto is trying to do that for sure, like the trust cost or the enforcement cost, right?
Mm-hmm.
That when I like send someone a Bitcoin transaction, for all intents and purposes, that is like irreversible. There's no, you have sort of like the settlement assurances of how the network is constructed, right? And you can like play out the game theory of like, theoretically I could reverse that transaction for however many million, X millions of dollars. And so wait for so many confirmations and,
and the big moment of trust is when you let go of your Bitcoin to receive your good, right? That's the maximum risk point.
Right. Yeah. As soon as you go out of Bitcoin land right now, they're like, I'm going to send someone Bitcoin. I'm going to get a sweater or whatever. Like, how do I enforce that they send me the sweater? Like that, that works either through the legal system or it's mediated by some platform like Amazon, who's, ultimately enforcing it through the legal system. But in a purely, Bitcoin transaction, we enter into like a multi-sig agreement.
Just escrow, basically, right?
Whatever it is, then there's no. I guess theoretically, there's legal jurisdictions there, but in practice, it is very, very difficult to sort of change the rules of how those contracts are done. So from sort of like the Bitcoin investment perspective, like that's kind of how I think about it. It's a network that's very large selector. The effect of the large selector is that it reduces trust costs. I don't have trust in any single individual. And so it has these qualities of censorship resistance, right? If I send a transaction over the Bitcoin network, it's very hard to stop. If I live in a country that has political censors or a Russian oligarch or whatever it is, I'm able to transact, and then it has inflation resistance, right? If I, to change the rules of the Bitcoin protocol in such a way as to increase the supply schedule so there's more Bitcoin produced over time is extremely difficult, right? You'd have to convince the majority of people running Bitcoin full nodes, which is like probably the more hardcore Bitcoin people, that they should like add inflation back in to the Bitcoin protocol, which is theoretically possible, but one can imagine like the level of coordination and like things that would have to happen to make that work.
I mean, is Bitcoin different than any other asset right now in that if I wanted to buy a home in Thailand with any asset I wanted, whether it be Lamborghinis or gold bricks or Bitcoin, I would have to pay some premium over the spot price in bot because the counterparty is taking on this like liquidation risk and they eat in bot and they have obligations in bot. So they have to like sell those gold bricks or those Lamborghinis or those Bitcoin and get them into their like local system, right? And so like in that way, like does Bitcoin's like use case ever get smaller? Like I see how it's great for international stuff or like, rich people in Venezuela can get their money out into Bitcoin. Poor people can't, but rich people can, right? Things like that. As a store of value and medium exchange type thing, what's your thesis there?
I mean, I guess like the way I think of it is there's like sort of like fractal levels of trust and effect. So like, if I, like my wife has access to my bank account and like, that's fine. Like, I'm not worried about that, right? Like that's a level of trust towards like, she can move all the stuff around. And then, you have various other levels. Like in practice, this is how sort of like social networks are arranged. Like you might trust me with $100. You probably wouldn't trust me with $1 million. You definitely wouldn't trust me with $1 billion, as it sort of goes up and the social network goes out. There's a level of trust there. And so I think like there's the way I think about like all these like scaling solutions is they're like trying to recreate that sort of like in different ways, right? So like what Lightning is kind of like, it seems like it's like a Bitcoin bank network, right? It's like there's going to be this, Coinbase is going to have their giant Lightning node potentially, and I connect to Coinbase and like I have some level of like counterparty risk.
Yeah. So I guess it's more the clunkiness, right? Because I could just send you whatever 100 Satoshis for a cup of coffee. Wouldn't matter, right? But the transaction cost and the lag is what's keeping me from doing it.
I think like at the base layer, right? Like there are transaction fees. Like I don't know what the transaction fees like $1 or $2 now. So like it doesn't. I'm not going to buy a $3 cup of coffee and pay $1.50 transaction fee. Like it's dumb. So like I guess it's not clear to me that like the medium exchange thing doesn't seem like it actually needs to work from an investment perspective. Like if it was just a store of value and like a kind of clunky, shitty medium of exchange, like it's probably, if it lives up to its theoretical promise, it's worth a lot more.
Because right now, I think everyone realizes there's no medium of exchange. It's purely a store of value or a speculative asset. So why would you get rid of your asset today that's worth $7,300 when the thesis is it'll be worth $20,000 in the future? Why would you spend it on anything today?
Yeah, I think that's, from people I talk to, like that's where most people are. Like it's a speculative position in their portfolio that has lots of upside risk and lots of downside risk, and
hopefully it's non-correlated.
And hopefully it's non-correlated, which I think is probably unlikely. But
yeah, like I'm gonna sell my high-priced art, my Lamborghinis if there's a Great Depression. I'm gonna sell my Bitcoin too. Like you're gonna sell all of it.
Yeah, I think the argument I've heard for like why it might be uncorrelated is like the question is like, is the holder base overlapping, right? Like of the 18 million Bitcoin or whatever it's at now that are like in circulation, like the people that own those, like what is their exposure to like broader markets, equity markets, real estate markets, et cetera. And like, I don't know, it's probably not like super high, right? Like you think about the people that own a lot of Bitcoin, like they're not the type of people that are, it's not institutional investors, right? That have like, mandates in terms of what their portfolio construction has to look like and all that kind of stuff. It's like, these like super libertarian people that got into it. And
they're buying it specifically because it's gold coins, right?
Right.
I think, like I remember this in Rockefeller's biography, like they said there's an interview of him during or after the Great Depression, and they're like, hey, what was that like for you? The guy was a trillionaire basically, and they asked him what the Great Depression was like for him, and he said, oh, it was great, everything was so cheap. And I can just imagine the Drapers and Winklevi running around buying up Bitcoin when everyone's like, all the weak hands are hitting market sell on their one Bitcoin, 0.1 Bitcoin, right?
Yeah, potentially. But yeah, I think that's the question to me, like to what extent is it owned by like institutions or like more traditional investors that are like I see it in that way. But it's also like, I don't know, if they do maintain their same portfolio construction, they rebalance, then like they're dampening the volatility and they're buying against the market, right? If the price is going down, they should be buying because they're rebalancing to maintain whatever their allocation is. But
I don't think there'll be active portfolio balancing during the high volatility phases, though, right? Everyone will just like stop and not act, probably.
I think like the institutional level, like I think like on the retail level, it's like you bought this Bitcoin at 1,000 and it goes up to 5,000 and you're like freaking out. But like I think at the institutional level, like I think there's more just like there's more controls in place, right? Like you can't just be like, oh, like maybe we should hold a little longer. It's like, no, that's not how it works. Like, you have certain like mandates and parameters, and risk controls and all that stuff.
Like for crypto, I see the huge use cases on an individual level, like multi-sig for my credit history, for my medical history, things like that, where I carry it around and I give people access to it, right? But like I haven't seen use cases evolve around that quite yet. Or like a voting ledger, right? Like stuff where you want publicly verifiable, maybe not traced back to the individual, but you don't want it to be hacked, right? Maybe other public goods as well.
Yeah, I guess like the question, so like, Bitcoin just itself, or like if you were to write like crypto store of value thesis, which like seems to be Bitcoin now, but theoretically could be something else.
I guess like that, blockchain versus Bitcoin, right?
Right, but that all makes sense. Because I mean, it's all on chain, right? So what you're trusting is like whatever the security guarantees of the chain are, which like we can, we can calculate exactly how that is, but for like all intents and purposes of reasonable size transactions, like they're pretty secure. But then like once, I guess the way I had like a 2x2, it's like you have sort of like, like how well oracles work along one dimension, and like basically the trust level you're able to get. On like a per transaction basis. So like right now what happens is like, as Bitcoin becomes more popular, the cost of sending a transaction because the block size is limited goes up over time. And so like that reduces the number of regulators. If there's some sort of like layer 2 solution, or you have like Bitcoin banks that are like trusted custodians or something, like some sort of like, fractal trust thing where you have, some layer of trust, and so you can maintain relatively high trust guarantees, maybe not as high as the base layer, but still quite high, and transact at that level, then you can get, relatively low transaction cost of trust, right? You still bring that transaction cost down, but without adding in that, the actual transaction fee of using the network. So like oracles work really good, and it's really easy to get real world data onto the chain, and you have lots of trust with relatively low transaction fees through some sort of scaling solution. Like, blockchains eat everything works on blockchain, some sort of like public blockchain network, blah, 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 and the inverse solution that like the Oracle problem never really improves, and it's really hard to get, data on chain reliably, and, none of the scaling solutions pan out, then like you probably don't get much beyond like Bitcoin and just like general store of value.
Mm-hmm. Cool. Is anything else you want to talk about on that topic?
No, I think that's good.
You want to talk about winding career paths in crypto? You've written a book about careers, right?
Yeah, actually, if this can be edited, can we do? I do have one other piece on the the thing. What was I going to say? So yeah, I think the interesting thing to me then, if you go like beyond the store of value thesis, and let's say oracles work reasonably well and scaling solutions work reasonably well, like then I think you start getting to something like decentralized finance or open finance, where you're able to have these sort of like trust minimized smart contracts, and you can do all these transactions, and then you get. I think like what's the interesting thing about the internet is this idea of like permissionless innovation, right? Like you don't have to like email someone at AOL and like ask them to like put up your website. The manager, whatever. It's like everyone would create a website, and like it turned out that was like very fruitful for innovation. That the fact that like developers could just like start tinkering away at stuff and see how it worked. You like sort of open to the innovation service area substantially, but you can't on the internet. You can't do that with money. Like you can't send and receive money in a permissionless way. So if you can get to that point where you can write financial contracts that don't rely on sort of traditional means of enforcement, you're able to like manage the trust costs through sort of the security guarantees of the blockchain. Like that seems really interesting to me, and like you could do a lot of things with that.
Yeah, it seems like you have to do it where there's discrete values and agreed upon values, right? So a stock market, that would make sense. Like as soon as $1,000 price threshold is hit, then this put or call fires and money transacts, right? Where it touches the real world, like a car insurance policy, where some human will have to input if that car is totaled or not. Like those things seem like it's not that different.
Yeah, I think there's like three. I think of it as like three tiers. There's like on-chain data, which is like you can you trust it to the extent you trust the chain in any respect. There's like digital data, which is like probably easy. There's sort of like I think there's like digital and general data. Like I don't think it's going to be that hard to get like who won the World Cup or who won the presidential election. Like you can probably use like prediction markets or some sort of like trusted oracle to like do that, or some combination of oracles, because it's very general knowledge and it's available in digital form. But yeah, when you get to like individual, like did Pat's house burn down, and was it arson or whatever?
Yeah, who burned
flight
it down?
Insurance, like now then again, you inject all sort of like individual risk. So it seems to me like that's going to be the distinction. Like there'll be different levels of how that works depending upon like what the trust stuff is.
Yeah. All right. Cool. I think DeFi is interesting. I mean, again, it's all marketplace, right? It is the reduction of search and transaction costs. And 1,000 years ago, that was saying, hey, there's a farmer's market here, and everyone bring your produce here, right? And then search engines were the same thing. Like all the vendors are coming to your desktop, and you can like sort between them, right? And you're just constantly reducing the search and transaction costs.
Yeah, I think that, and the lower the transaction costs, the more of like exchanges mediated by markets is like the way I think about it. So like in a world of there's perfect information, it's perfectly searchable, it's perfectly measurable, negotiations happen instantly and everyone agrees on them, and you have zero counterparty risk, then like no firms, you do everything in the market, everyone just transacts with everyone else because there's always perfect. Like you obviously you never get to that world, like that's
Mm-hmm.
impossible, but as you move more in that direction, you get sort of a markets reading the world phenomenon.
Mm-hmm. Yeah, so you want to talk a little bit about like winding career paths and how people kind of end up in crypto. You and me have kind of taken interesting paths to find ourselves in crypto, and you've written a book about careers as well, right?
I have, yeah. Why don't you start? How exactly did you wind into crypto?
Yeah, so for me it was I studied chemistry in undergrad, and then I was a helicopter pilot, and then I went got my MBA in basically finance and accounting. So I become an iBanker. So I was an M&A investment banker for a year, and then ended up in tech startups, and then ran a retail business at Amazon, and then ran some more tech startups. And in the summer of 2017, I was kind of like, you know what? Like, I'd always wanted to be my own boss or CEO or whatever. And it just felt like that was the time where I'm like, you know what? I think I can be a VC backed CEO, and like that's what I should try to do. Like, let's do that. Let's see what that is. And so then I thought about where I should do that in, and that felt like fintech because I understood finance, I understood tech, and I was fine with risk and entrepreneurship, um, and have confidence that I can learn whatever I need to learn. And then as I was looking around for business ideas, crypto was like right in your face in the summer of 2017. And as I thought about more infrastructure type plays, tax, personal tax, capital gains tax, uh, was obvious. And I just kept talking to people who were in crypto who had these tax problems, who were writing their own computer scripts to try to bring everything together. The IRS was suing Coinbase and subsequently won it. All sorts of individuals were flooding into the retail space. So, and I looked at the incumbents and I thought, well, like I think I can beat them on UI, UX, and automation if I get funded and build the right team and kind of like outwork them, outmarket them. So that was the whole thesis. And 2 years later, we've have a 15-person team. We just closed another round with 5 VCs raising $3.3 million. And it turned out, to work out. But at any number of points, at least 3 times, the company could have died. So a little survivorship bias there.
Yeah, as it always is with these things. Um, yeah, I think I guess the way like my big thinking about sort of careers and how careers are changing is through this framework of like sort of like complicated versus complex careers. So, like historically, careers have been so those are the sort of like system science terminology. So complicated is some system in which you have interacting parts. You have lots of parts that aren't necessarily interacting or interacting in limited ways. And then a complex system is where you have many different parts and they're all interacting with each other. So like markets are an example of complex systems. Or like usually the example I give is like a car is complicated, right? Like it's not like I can like rebuild my carburetor without like having to learn a couple things. But like once you know how to rebuild a carburetor, you can like do it deterministically with 99.5%
Mm-hmm.
success, unless you get drunk and mess it up or whatever. Because there are a lot of parts, but they all interact in pretty predictable ways. But you can't rebuild a horse, right? Like
Mm-hmm.
once you take the liver out, you can't just like stick the liver back in later, like the horse is dead.
Mm-hmm.
That's not how it works. So from the career perspective, I think we're sort of moving from this like complicated work paradigm to a complex work paradigm, right? Where like the paradigm used to be, you go to school, you get some formal education and, whatever your thing is, accountant, lawyer, engineer, blah, blah, blah. Now you have that thing and you just sort of do that thing for the next 40 years with, mild variations and some continuing education and whatever. Whereas now we're more in this paradigm of like, whatever the latest McKinsey report says, 40% of jobs that exist in 2030 don't exist now. And so it's this much more like complex, interdependent, that sort of lends towards more sort of entrepreneurial work approaches, right? Trying to see how the market is shifting, see how the dynamics are changing, and looking for sort of new things in there. So there's a really good there's a researcher who I've been trying to get to respond on emails for years and hasn't, at UVA, named Sarah Sarasvathy. And she's it's like the only like academic research on like entrepreneurialism that's like ever like actually made any sense to me. But her idea is this notion of like, she calls it like effectuation or effectual reasoning, that like when you like teach an MBA, I'm showing MBAs now that I'm talking to you about getting your MBA. You typically, the way in like MBA classes that like market research is taught is you do this like sort of top-down analysis. Okay, what is the total addressable market? Of that, what is the serviceable addressable market? What is the serviceable attainable market? We're going to put in a spreadsheet and we're going to like build in certain assumptions to like, calculate this out, and we can, sort of like determine the market. And okay, like the market size is $100 million. And so if we can, attack it for some substantially less than that, we should take the risk, whatever. And her point is like, in practice, actually, like most people that are good entrepreneurs start like bottom up, not top down, right? Which is like, what are my skills? What is like my network? Who do I know? And then like, what are my other resources? Do I have capital? Do I have whatever? And then, how can I combine those in some like new and interesting way to create some new possibility that makes sense in the market. So I think that's like, if you look at like most people with sort of unique career paths, like it's usually like, it's like, oh, I was doing this thing, and like it turned out this thing was like kind of similar to that thing, so I started doing that thing, and then like this thing and that thing combined were like this other thing, and like that turned out to be a really good idea, and like I was the only person that had 5 years of experience in kind of esoteric thing A and kind of esoteric thing B. So like I was really well positioned to do super esoteric thing C that ended up growing into a huge market, which like no one else could really take advantage of, and like was not deterministically possible. Like I couldn't have put on a spreadsheet 10 years ago that I should like get these two skills, because combined they would end up in something interesting.
It's not a news story either. Like, two of my favorite biographies are Grant and Sherman, two Civil War generals, and both of them had these like very careers where they like failed at farming, failed at banking, failed at railroads, got stuck in their military careers. And then when it came time, they were like 40-year-olds with combat experience who had to like destroy another country, and they knew how to do it. They knew how to do it on the battlefield, and they knew how to like go destroy the infrastructure of the country, and they were like uniquely prepared for it. But they also had to like, survive all the economic downturns, and then like miss all the cannonballs and bullets along the way too, right?
Yeah, I guess though, like there's necessarily, Taleb has line, it's like mild to moderate success is attributable to hard work and intelligence, and wild success is attributable to variance. So like,
because there were other Civil War generals, and they tried them, and those guys all got fired because like they didn't fit the situation, and they just kept trying generals until they got lucky with the ones that did fit the situation.
Right. Yeah, I think that's, sometimes you just like hit the pair. Like if you run the Monte Carlo simulation, like Jeff Bezos probably ends up very successful in like 95% of those scenarios, but like he probably doesn't end up as the richest person in the world in like 95% of those scenarios, right?
Yeah.
There's some level of variance there. Like,
yeah. And that's, I don't think that's why like you shouldn't read like Fortune magazine to find inspiration, like be the next Zuckerberg, because it's like, it's not, you shouldn't try to be the next LeBron James either, because you weren't born with 6'9" DNA genes with like massive fast twitch or whatever. Like, just sorry, like it's not going to happen, right?
Yeah. I've been wanting to write an article for a long time. I call it like the Maginot Line problem, which is like people tend to learn things like too literally and specifically, right? So like France got invaded by Germany at the start of World War One, and they're like, oh, this sucks. We got like crushed by Germany, so like we'll just build like a giant wall, exactly on the border where they walked across last time. And like I was like, oh well, that'll definitely work. And like the more general problem is like, how do you think about Germany and like its threat and its aggression? Like, of course, like Germany ended up just like going around the wall.
Yeah,
so it's like there are other ways to like walk into France.
It would have been valid in the 1880s or even 1900 for that strategy, but the advances in the internal combustion engine that went into tanks and aircraft, and probably some chemistry advances, probably like kind of made it obsolete at exactly that time.
Right. Yeah, markets are dynamic, right? They adapt, and so you can't, by definition, you can't have some fixed approach to it, because the market will will arbitrage it away. I think you can almost think about like a lot of like traditional credentials from like an arbitrage perspective. So like from 2000 to 2010, there were more college graduates worldwide than in like all of history up to 2000, right? So from just like a pure supply demand perspective, like you have this asset, at least in the United States, for which the cost is going up, and the supply is going up, and the demand is like maybe going up a little bit, but not that nearly as fast as the supply or the price. And so like it makes sense that the return on that asset would be decreasing.
Yeah, well, it is if you change the unit of value, right? So if you change the unit of account to 2-bedroom houses within 10 minutes commute of your work, then the value of your degree has gone down massively, right?
Right. Which it's another layer of it.
So if you just count in dollars, then things look weird. But if you account in what dollars can buy you, then it probably is obeying the market forces.
If you count in dollars, it's weird, but you count in dollars of what?
So like a gallon of gasoline costs like $3.50 now, right?
Okay.
And so I think it's capturing more the substance of the value of dollar. Like it's not like that gallon of gasoline's 3.5 times more efficient or valuable to me than when it costs $1 for a gallon of gasoline, right?
Right. I guess like with the commodity, like with the gasoline now, it's like that's the production cost, right? So like there's like marginal users of gasoline. That, like,
that's true. There's also taxes too. Like Californians pay a different gas price, and then distribution.
Texas gas is like $2.40. So
yeah, maybe gas isn't the right one, but there's some units. I had a business school professor who said it was Porsche units. Like the cost of a 911 at any point in time was like 50% of a professional's like annual income or something, right? Or 100% 1 year's earnings.
So you can like measure the cost of college in Porsches.
Yeah.
Over time. Yeah, I would think that's interesting. Is the cost of Porsches changing? I would think the cost of college is going up significantly faster than the cost of Porsches.
Yeah.
Yeah. So it's not like dramatically different from measuring it in dollars.
Mm-hmm. But
like
then
the real estate thing makes it worse, right? Because the cost of college is going up, the return is going down, and the cost of real estate is going up. So like, the MBA 30 years ago bought you, 3,000 square feet of house, and now it buys you 500 square feet of studio apartment.
Yeah, but if you didn't have so many NIMBY restrictions, you could just have a bunch of like really nice 100-story high rises where people went to work, and
Yeah, the NIMBY stuff is starting to hit Austin too, which is making me nervous.
Well, interesting. Yeah, did you want to say anything more about careers there?
I'm good.
All right. Cool. So I think we also I just finished fundraising, and you are like about to start fundraising, but kind of for like different reasons. And I think there's a good amount of people that want to listen to this that are entrepreneurs or are thinking about it. So we could talk a little bit about that. Do you want to ask me some questions about my experience? Or
yeah, Pat, what are your three? If you would go back and talk to yourself pre-fundraising, what are like the three biggest things you would tell yourself? Like what are the three like positive pieces of advice? Like you should do this works well, and maybe the three like negative pieces of advice, like don't do this is a common mistake everyone makes.
Yeah, so this was my third round of fundraising in this startup. So I had like a lot more confidence this time around, and we had a lead investor from the start. So those like dynamics totally changed it. January 2018 was scary to start because we put like a very ugly deck together. We had a team that had not worked together. And we had a highly volatile like cryptocurrency market, and we were just trying to bring together like a bit of seed capital, and that felt like really iffy. But I gained confidence as I was pitching. So again, like I picked a career field where I'm really strong, where I'm a 6'9" like super athlete because I seem to be pretty smart and communicate well, and I check a lot of boxes that investors are looking for, and that's part of my narrative. Like, are you smart? Are you hardworking? Do you know what you're talking about? Are you competent? Are you a leader? Do you have integrity? Are you going to steal money from me? Can you sell? Can you sell this thing? Can you raise another round of funding? Will you be transparent and communicative with me? Like, I can answer all those really quickly, usually just with my resume, and like within the first 5 minutes of the pitch, like I can tell like I've won over the investor. And that's taken a lot of practice, but then it's also a lot of luck in there as well. So like to me personally,
what are the things you think that like work for that? Is it like companies you've previously worked at? Like, is it particular credentials? Like, what is the narrative, or like how do you tell that story that checks those boxes?
So in general, I would say, so Justin Kahn of Justin TV, which became Twitch, which sold for like $100 million to Amazon, and then he started up this thing called Atrium, which is like a better way to provide legal services. So he said, if you're young and don't have any experience or assets or anything, take market risk. Like, go do something no one else is doing and hope the market shows up and that you've solved like some problem that no one saw, and then you can have success there. If you're established and you have capital and you have expertise, then take execution risk. But he went after legal services because he already knows like people spend $100 billion on legal services. Now, if you just provide it faster and cheaper, then people buy from you instead. And you're just banking on the fact that you can execute better than the competition or the current status quo, right? There's a difference there. And so I guess with me, I would say that like I don't know what it's like to be a 21-year-old like software guy and try to do a startup then, but I just can't see it succeeding most of the time. Obviously it doesn't. There's like a 90% failure rate. I would like be more patient with myself, and like I'm glad I took a windier road. It was painful. There were like several times where I was like, you know what, I'm just gonna go like live overseas and run an internet business, right? Like I'm gonna stop like putting myself in the meat grinder like and trying so hard, right? But I like purposely picked my fight. Like for 10 years, I was like trying to build myself up to be a CEO. And that was what I was always thinking of. But I always knew I had the capability to do that. So maybe there's like this confidence in myself, but also I kept doing hard things and succeeding. So like every like school I've gotten into is very hard to get into, and I did well there. Every career I've had was very hard to get in, and then I did well in that career. So like I already knew I was like quite capable. So I don't know.
When you're talking to investors, you feel like it's like the way you signal that to them, right? Because like that's an interesting question. It's like, how do you, like, all those boxes make sense, but how in like a pitch deck or a 5-minute presentation do you like compress that information in a way that like signals all those? Like, do you feel like, is it mostly like it's like worked at Amazon, worked in iBanking, went to Booth?
That's exactly it. So they're, like I wouldn't send my deck out a lot. I would actually send a short email that like got forwarded by a warm introduction, hopefully. And then I would get them on the phone for a half hour, and then I would send a deck afterward, because I didn't want them to look at the deck and reject that out of hand. I wanted to be able to sell them, and I also wanted to get feedback, because at least when you're on the phone or video conference, I'm going to learn something from that. If I send my deck off to you and you never reply, I haven't learned anything. I've wasted an opportunity to learn and get better at the pitch or whatnot, right? So, quick email where it says like, hi, Zenledger is this business idea, and in 2-3 sentences, and they're going to get it or they're not going to get it. And then 2 or 3 sentences of bio on the co-founders. So that's like idea, team, can I have a half hour, right? And then the phone call is the narrative of that. Like, here's the problem, you know it, I know it, here's our solution, here's how we're going to execute, go to market, here's the team, here's how we're going to use the money, here's our traction so far, here's what we plan to do in the next year or two. And that's the whole pitch, and just keep doing it, get better at it, but also just get in front of the right people. So it's also like, it's not just how you pitch, but who you pitch to, right?
Yeah. It's I think about the credentials thing, because like I have basically no credentials, right? Like I went to, I think according to U.S. News and World Report, the 573rd best liberal arts school in America, which is like basically the same as going to a community college.
Can you position it as like top 10% university in the world?
It's the Harvard of Alabama is how I like to refer to it. And then, I worked for like some small companies, but like never like a, FANG kind of thing. It's like interesting for me, like talking with like traditional finance people, like raising money for a hedge fund, and they like look at my resume and they're like, who the fuck are you? And like,
Yeah.
why are we?
So you very much have to get to the conversation, because in the conversation you can display your expertise, right? Like, you're well read, you've accomplished things here, here, here. Here's why you think you're ready to do this, and then here's your partners. Here's how it's all structured, right?
Yeah, I think we get around a lot. Like we intentionally partnered with like a very well-known firm in the industry with like well-known people, and like that kind of gets us in the door. Like our partner sort of says like, oh, these guys are legit, you should talk to them, and then we can have like the hour conversation.
And so for context, like, I was fundraising for a fintech startup and you're fundraising for an investment fund.
Correct. Yeah. So I think that's like one big difference. I guess the other thing I'm interested in your thoughts on are like so it seems to me, I've never raised money for a startup. I've like looked at a fair amount of decks and known people that have raised money, but like a lot of it is like a scarcity narrative, right? Which is like the joke is like, you email your first investor, you're like, round's about to close, we have a little room left, like, are you interested? Right? And then you play the scarcity narrative and you play everyone off each other. All right, we lead investors going, round's closing in 2 weeks, we have a little space left, do you want in? You tell everyone that, and then everyone FOMOs and throws money in. You can't in the hedge fund space. That's illegal. Basically, you can't use scarcity in your marketing, or you will get sued by me.
Do you also need like a verifiable track record of investment?
You don't have to. You have to get the regulatory process is you have to submit what's called like your offering documents, your private placement memoranda. And you can, if you want to use any return numbers in that, you have to include that in that document, and they have to approve that document. So like in practice, most funds do like back test, or like it's a fund manager that's like trading in their proprietary account, and they'll get that audited by some third party auditor, and they'll use that as their back test.
Okay. Yeah. So I would say like, lacking credentials, you have to show traction, or you have to like, the quality of your idea and your team have to shine through. So like those, you just have to realize what your strengths are. And if your story is a little different, then pitch to those guys. So if like you came from Alabama, then pitch other guys who like, did the same thing, right? Like
all the investment managers in Alabama.
Yeah, or whoever runs like the 100 Tyson chicken farms in Alabama and is totally. Worth $100 million. Like
that guy lives there. I think I know him.
And he's tired of having New Yorkers call him up, right? So like that was the other thing. Like when you don't know where to start with people that have like 2 or 3 things really solidly in common with you. And the people that will go out of your way to help you, because like the theory of weak ties, right? So the people you have the strongest ties to already know that you need help, and they can't help you, or else they would have, and you wouldn't have the need, right? So you have to move like out to people you don't know that can help you, and like you do that by your strong ties first, then weaker and weaker ties. So you're generally always going to raise money like first from people who know you really well, and then from people who don't know you at all. That's the barbell of it, I guess.
Yeah, no, I guess for context, the fund is sort of a tail risk black swan fund. So sort of like philosophically similar to crypto, but sort of just a different financial instrument to get sort of a theoretically similar exposure, sort of from a diversification perspective. But yeah, I think we're just starting the fundraising process, so we're still growing up. But so far, our experience is like if we can get someone that's like very philosophically aligned, right? Like they see the world in a very similar way that we do, and they're just like looking, like it's one thing to have a thesis on the world. It's like another thing to like find a vehicle to express that thesis in an accurate way, right? Like if you think the market is going up or down, you can like go buy options on that, but like, how far out of the money is the option? Like what's the delta of the option? Like what's the expiry? Like you can be right, you can be directionally correct and still lose all your money. So that I think that's sort of what our experience has been so far is like, well, if we're at least philosophically aligned, and it's just like I've been wanting to do something like this, like I just couldn't find a vehicle to express that opinion. Like then there's like an interesting conversation to be had.
Yeah. There's a bunch of there's probably some really interesting ways you could start conversations with those people. One is just kind of like, you can't market the idea, right? Like you can't like, I guess you could record like a YouTube video of you talking through the thesis, but you can't like direct it at people. Or, can you? I don't know how that works.
We're going to do a podcast like what interview. So we're technically a fund of funds.
Mm-hmm.
So like we don't actually enter the trades. We have 7 sub managers that are actually in trade. So we interviewed all of them and then sort of like had a podcast talking through our thesis. But yeah, I mean, I think just, research and you explain the idea to people, and that's going to resonate with some segment of people that go, oh yeah, like yeah. I mean, that was how I got into it. I met my partner because like I was trying to find this, like I was looking for this vehicle. I was like researching my own investment, like how do you structure this, and like it didn't exist. There was like no way, it was for a non-institutional investor, someone with like less than $10 million to like invest in some sort of like tail risk product. Like my opinion was that most of the products on the market were not that great.
Yeah.
So
yeah, certainly the first time I read Black Swan, I was like, oh, so if I bought out of the money puts and for whatever $5,000 or $10,000, like I would just take a terrible risk, and it doesn't seem like the best way for me to go about these things.
Yeah, I think there's like ETFs that like just they call like rolling puts, right? Where you're just like buying 2-month 20% of the money puts on the S&P, but those things tend to lose 10 or 12% a year in good years. So like if you don't time the market just perfectly, you could like lose half your money. So even if you make 100% return when the market crashes, like you're just back to break even. So finding
and then you have to sell your stake in the ETF before everyone else does, right?
In case it decouples from the underlying. Or
yeah.
What do you mean?
Yeah, I don't know.
Yeah.
I guess the liquidity there would be weird.
Yeah, I don't think, as far as I know, like the sort of like just mechanical put buying ETFs are like, like your risk is that the ETF trades more liquid than the underlying, and so if you have like a big move, the underlying that whoever's managing the ETF can't actually rebalance the underlying, so decoupling the underlying from the ETF.
Yeah, because I mean, my thesis on buying out of the money puts is that you hit a liquidity event, right? Like that's what makes the value of them skyrocket.
Yeah, right. Like you want to own the options and be the market maker, like when the spreads blow out and the market tanks, right? Because then you're the one that owns the insurance policies, and like suddenly everyone wants insurance, and so you can rip their faces off, as they say.
Yeah. So an ETF would be this weird way to participate in that, which doesn't seem to bring you what you're actually looking for there. Well, cool. Well, cool, man. That was a cool, wide-ranging conversation. I appreciate it. That was fun.
Yeah, that was fun. Thanks for having me on.
Yeah. Talk to you soon. Good luck with the fun.
All right.
Bye.